I'm Corey Hurwitz, Manager of National Accounts with BMO Global Asset Management. My main focus is to help our discount brokerage partners, such as BMO Investor Line, providing education to help their clients make informed and thus optimal decisions. Today, I am talking with Daniel Stanley, Vice President of BMO Global Asset Management. Daniel is a CFA charter holder and brings over 15 years of capital markets experience in the United States and Canada, with particular expertise in exchange-traded funds. This is one of several conversations about smart beta. Today, we'll be discussing specifically how to use smart beta when building portfolios. Dan, perhaps you can explain how the investment industry has changed its thinking about what drives returns.
Thanks, Corey. The history of smart beta is driven by the historical evolution of ultimately how finance views the sources of return. So back in the 1970s, it was all about total return. Then in the 80s, it was all about alpha, which is manager return, and beta, which is market return. While the 2000s has seen a research-driven deconstruction of the different sources of beta.
How about the traditional thinking on diversification?
Yeah, the 2008 financial crisis made it clear that standard asset allocation and diversification among stocks, bonds, and cash didn't work, and it led companies like MSCI to create, along with the ETF companies, factor-based investment products for the everyday investor. Now, MSCI says that a factor can be thought of any characteristic relating a group of securities that is important in explaining their risk and return. The factors that MSCI has identified as having earned a long-term risk premium include momentum, quality, size, value, low volatility, and high yield.
Dan, how does smart beta fit with passive and active investing?
Well, Corey, smart beta is meant to take the best of both worlds. It's meant to take low cost from passive investing and process from active investing. But ultimately, the key to success of smart beta relative to active management is the transparency. Transparency of the holdings, transparency of the process, and transparency of rules. You know exactly what you're getting, and thus it helps you with your asset allocation process.
As expected, there must be some critics with respect to smart beta.
Yeah, smart beta ETFs really are just the next stage in the evolution that started with passive index funds. These funds were launched back in the 1970s, but back in the 1970s, those products tended to be expensive and they really weren't that accessible to the everyday investor. So this ultimately led to the evolution that has improved both investor accessibility and specialization. But with any evolution comes criticism. One analyst said in a presentation that I attended last year, and I quote, "If I short smart beta ETFs, does that mean I'm long stupid?" All humor aside, there are some common concerns about smart beta ETFs.
Having said that, can we dive a little deeper into some of the main criticisms of smart beta?
Yeah, certainly, Corey. When I'm out on the road meeting with clients, the criticism number one that I hear is that smart beta ETFs track custom-made indices that were designed specifically for the ETF in question, while the original market cap-weighted ETFs tracked long-established indices. A second criticism that I often hear is that smart beta ETFs crowd trades, forcing too much money into certain stocks and ultimately eliminating any excess returns. And a third criticism that I hear is smart beta ETFs are just active managers in passive clothing, trying to win back market share while charging higher prices. This is the purest passive investor argument from investors like John Bogle and Rick Ferry.
So Dan, how would you respond to those criticisms?
Well, I like to tell the story about Rob Arnott, who's the founder of Research Affiliates. Rob Arnott says that what smart beta does best is to sever the link between the price of a stock and its weight in an index, taking emotion out of the picture. So as an example, back in 2009, the FTSE RAFI Exchange Traded Fund, which is a fund that is managed by Rob Arnott, doubled its positions in Citigroup and Bank of America. And this was happening just as government measures to end the market panic started to take hold. The fund returned 42% for that year, which was 2009, compared with a 26% return for the S&P 500. Thing is, though, that was a very difficult trade to make. So difficult, in fact, that a client for whom Rob Arnott manages money in a separate account that mirrors that FTSE RAFI begged him not to make that trade.
So what happened next?
Yeah, well, Corey, what happened was Arnott eventually yielded. He didn't make the trade. And the client's portfolio lagged the fund by 7%, proving again that the more uncomfortable the rebalance, the more likely it is to be profitable. Smart beta tries to shield you from the bulk of this discomfort. In summary, smart beta ETFs may help you asset allocate more effectively by giving you exposures beyond what you get from the broad market.
Dan, thank you very much for your comments today.
Thank you, Corey. It's been a pleasure.